Hello and welcome back to the ROI Channel, the channel that's obsessed with the art and science of return on investment. It's a Sherpa-powered professor of the degenerative kind today. He's back. He's renewed. The mate is flowing through his veins to his brain. And today we're going to talk about some of the gems this guy throws my way. I love it. We're going to talk about Finance of America, medical properties trust if we get time, and anything else that happens to come along our way. Guys, subscribe to the man's Substack. Link will be in the description. If you do, you can go through and find an article that was written months ago around Finance of America company. It was like I felt like Michael Burry finding an undiscovered opportunity here. The market cap at the time was like 47 million. You've since more than doubled, nearly tripled market cap today, 117 million. Professor, take us through the thesis behind Finance of America companies, a truly, truly rare opportunity to buy Ben Graham type net stock in today's environment.
Yeah, no, this was gets back to that Peter Lynch quote, like just whoever turns over the most rocks wins. That you turn over rocks and you find stuff. And this was one that I wouldn't have known how much of a beneficiary it was going to be from rising interest rates until I dug into it, and there it was, and it was amazing. It was incredible. So Finance of America companies, the symbol is FOA. When they went public about 5 years ago, they were kind of like rocket companies. It's another company I've been following. They changed CEOs twice, and then I didn't have the time to re-underwrite them back then. But Rocket Companies is it used to be called Quicken Loans out of Detroit, and they rebranded as a very mass market oriented mortgage origination, mortgage servicing, but they're also stealthily trying to become a consumer finance app. So I was following them because before Ozempic and before artificial intelligence, the question about who was going to have the super app in the United States that handled everybody's financial transactions was a really big deal. And Rocket Companies, through having this massive lower income foothold, might even win, or at least get acquired at an unreasonable price. So I've been following Rocket Companies for a while. But Rocket Companies handles everything in the whole mortgage space. When Finance of America Corporation went public, that's what they were like. But then they started selling off some parts of the business, and they narrowed themselves down to one niche piece, which they were the largest in the market for. And then they acquired the number 2 player in the market. So now they have 37, they only do one thing, and they have 37% market share in that niche. And that niche is called reverse mortgages. Do they have those in Australia? Is that a thing where you guys are?
Yeah, so technically it does exist. It would be extremely rare for you to find someone that has even heard of a reverse mortgage. And so I'd like you, if you wouldn't mind, to explain this concept to someone like me who is very high on the Neanderthal scale. How does this thing work? And then how do these guys make money off it?
Yeah, so it's kind of an amazing to watch the money move around, but that's where the secret is. But so my best friend since 4th grade, his grandmother did this with her condo in Miami. And since her kids were all doctors and lawyers and nobody wanted to inherit the house, everybody was thrilled. The idea of a reverse mortgage is, suppose you own your own home. Suppose you're retired, you're a pensioner, you have your fixed income. In the United States, we have a Ponzi scheme. In Australia, you have the superannuation fund, which I wish we had the foresight to not make a giant retirement Ponzi scheme. Most Americans have no clue that in Australia, you have an account with your name on it that your children can inherit if you die prematurely. We just get sucked into this massive Ponzi scheme, which has turned all the young people cynical, and they think the boomers have ripped them off, which is kind of fair because they have. Anyway, suppose you're on Social Security in the United States, but you own your own home. And this is, if you take the median 65-year-old, that's the position they're in. They have zero retirement savings, they have Social Security, and they own their own home. There is a huge swath of America that's in that boat. Zero retirement savings, but they own their home and they're on Social Security. Well, that goes on well as long as the husband and wife are both living, because 2 Social Security checks can handle a lifestyle. If your home is paid off, that can handle insurance and taxes and lifestyle, and it's relatively comfortable. But just statistically, what usually happens is the husband dies. I mean, because most people, when they get married, on average, the man's a little older than the wife, and the man dies a little younger than the wife. So most women have to plan on being a widow for about 10 years, just on average. So now you're on one Social Security check. And now you're old, and there's a lot of comfort that comes from living in your own home. And you could sell it and move into, a little Golden Girls community or something like that. But at that age, a lot of people would just rather be with their own furniture and their own stuff and their own home and their own neighborhood because they know it and they're comfortable. So a financial company will offer you something called a reverse mortgage, where every month they're going to send you something like $1,500. And that $1,500 comes out of a HELOC, a home equity line of credit. So, the first month they send you $1,500, and now there's $1,500 of equity that company has in your house. And with compound interest, the interest starts out very small, but it does grow. But also, since house prices are going up 5% a year, you could probably reverse mortgage a good long while before you run out of home equity in the house. So, if my grandmother lived to be 99, that's kind of pushing it. But for a lot of people, if you need to make it 15 or 20 years of them sending you $1,500 a month, it's going to work out, and it's going to add a lot of comfort and some income when you have no other source of income because you can't work anymore. It's way better than being a greeter at Walmart.
Yeah. So you've got your equity that you're now turning into a monthly form of cash flow, and every equivalent amount plus some interest of that cash flow that's given to you, this reverse mortgage company takes more and more of a share of the equity against your home.
Yep. And then the way the company gets paid eventually is within 1 year after the person passes away, their estate has to sell the house. And then just like if you sell a house with a mortgage on it, that portion goes to the bank, to the reverse mortgage company. And even in the US, this is a very, very niche product without a lot of volume. But since during the coronavirus stimulus time, we increased the money supply by 40% and then interest rates rose, anybody who had bonds were devastated. And if you were in any of these target date mutual funds and you're in your 60s or 70s, then you're 60, 70% bonds. So whatever retirement savings they had got crushed. And then as they get any income from the bonds, well, now their prices of groceries have doubled. So even if they did have some moderate retirement savings, so some people are in a painful boat. Meanwhile, house values in Tampa, they've doubled, but in the rest of the country, they're up 40, 50%. So Americans have a record amount of home equity, even in real terms, even inflation adjusted. The US middle class has never had this much home equity. And at something like 65% of homeowners of retirement age, they own their house free and clear without a mortgage. And this is just CNS is like something like $13 trillion that the American middle class now has in their equity in their primary residence, the houses without a mortgage on them. So this is enormous amount of wealth that could be tapped into. And I think this is one of the ways that's going to happen. I mean, young people might refinance if interest rates go low enough. They might take out a HELOC, a home equity line of credit, and buy a boat or a jet ski or a motorcycle. But older people, this reverse mortgage has a real chance of really accelerating because the demand is there. I mean, the baby boomer generation is retiring. And when 2 Social Security checks go down to 1 Social Security check, and you're forced with, well, do I sell the house and move into some senior community? Or do I do a reverse mortgage and stay in my house where I'm comfortable? I think there's a lot of people that might take that option. So I think that this has a huge secular tailwind to it. But so one aspect of it is just that this stock was so beaten down because when interest rates rose, volume fell off a cliff. And then when we had that banking panic with Silicon Valley Investment Bank and First Republic, then volume fell off a cliff because nobody's going to sign one of these, very intimidating contracts when you have a banking crisis. Now that interest rates are
let me
falling,
comment on that price decline. So 5-year decline, 90%, 3 years down 76%. And the chart looks just like a kid's slide, and at the bottom there we start to take an interest when we see something like that. The
Yeah,
very
and it started
generous APR.
inflecting up, so it's already doubled. But I mean, this thing, just because it's already doubled, it's not like I'm trying to unload my bags on some unwitting YouTube followers. I mean, this thing has so much room to go from here. It could easily still be a 10 bagger, even though it's already doubled. And go ahead.
We've set the scene here and the market in the opportunity for this particular market. But why Finance of America? Because they have what, 37% of this market share? Like, these guys are in pole position to capitalize from all this potential influx of demand. How do they make their money? Because they then securitize these things and on-sell them, right? Because that's the part I'm really interested in.
Yeah, so this is there's only a handful of companies that do this, that operate in this space because it's a very niche product. And then keep in mind, this company, they have to send all these old ladies checks in the mail every month. So where do they get the money to do that? And some reverse mortgage companies, that's just one thing they do out of their entire banking empire, and they have other funds to send them. But there's two companies in this space that's all they do. And so once you have this home equity, so you have to send this old lady a check, you have this home equity. Well, what they do is they take that home equity and they sell a mortgage-backed security, right? So they sell 5-year fixed mortgage-backed securities. Now, with the reverse mortgage, you don't really know what the life of the loan is. So as the equity accumulates, well, they take that equity and sell a new 5-year fixed mortgage-backed security. But they keep the term very short. So they keep it at the 5-year fix. So if interest rates change, it shouldn't hurt them too much because the duration is so small. It's 5-year fixed, but callable after 3 years. So in the worst case, if interest rates move against them in the worst possible way, it's a 3-year bond, and interest rates only affect 3-year bonds so much because it's 5 years callable after 3. So they sell a mortgage-backed security to get the money to send the old lady that monthly check that she needs for her living allowance. Now, to fund themselves, they have to pay themselves a mortgage origination fee. So when they sell that mortgage-backed security, they sell it for more than the home equity that they have, because they have to include their own, just to have some revenue to keep the lights on, they have to pay themselves a mortgage origination fee. So if you look at their accounting statement, I mean, first of all, their accounting statements are totally impenetrable because they use a mortgage REIT system. So, I mean, good luck. I think you always have to ask, why is the thing mispriced? In this case, the thing is mispriced because nobody except for mortgage REIT specialists could ever read their accounting statements, and the whole thing is a total nightmare. But if you see what kind of, if you can even figure out what kind of income they have, they pay themselves a mortgage origination commission by selling a 5-year mortgage-backed security for slightly more than the home equity. But to recover that over the course of the 3 to 5 years, the fixed mortgage-backed security they sell is at a lower interest rate than what they charge the old lady on her HELOC, on her reverse mortgage home equity line of credit. So now, normally, go ahead.
How does that work? So if they're selling the security to someone at a lower rate than what they have to pay the old lady, how do they not run out of cash?
So their home equity is increasing at floating rate mortgage values, and they're paying to the mortgage-backed securities market 5-year fixed. So they're paying very low interest rates, and their home equity is increasing at slightly higher interest rates. It was slightly higher floating rate mortgage rates until Jerome Powell increased interest rates from 0.3 to 5.3. And I didn't know that this company was going to benefit from this way until I dug into it, because if I was thinking, oh, who benefits from higher interest rates, I would have never thought of these guys. But all of the volume they did leading up to Jerome Powell's interest rate hike, they had sold those mortgage-backed securities at an average interest rate of, I think it's 3.2%. So they're 5-year fixed mortgage-backed securities. Before the increased interest rate environment, that was a tiny interest rate. That was really small. After Jerome Powell raised interest rates, they were charging the floating rate mortgage rate on these HELOCs. So they were charging the people that took out these reverse mortgages for the last 2 years, 7.9%. So for the last 2 years, their home equity claim on these houses has gone up at 7.9%. and they've been paying 3.1.5% on these 5-year fixed mortgage-backed securities.
So that's a nice spread.
And for this, when I found that it was a 47 million market cap company, do you know how many mortgage-backed securities they had issued at 3.19% to be collecting a spread on at 7.9%?
There's this guy's Substack who I read. He seems like a pretty smart guy, and he says it was over $1 billion worth. If I'm
about $7.5 billion.
Okay, so a spread of about 4.8% on that would be
about $350 million a year.
When this thing was trading at 41 million.
Yeah, it was trading at $47 million market cap, and they were getting $350 million a year in a stealthy way that you can't see, because this isn't going to show up in their financial statements. And the first of these fixed rate mortgage-backed securities is going to come in April 2025. And it's going to come in with having achieved a 4.8% spread capture for a couple of years. And even though interest rates just fell, they're still higher than because all of their 5-year fixed are at 3.15%, and they're still going to be capturing probably about 6.5% right now in the floating rate. So that's $7.5 billion of mortgage-backed securities that they're catching a 4.5% spread on. Is going to be over $1 billion by the time we've gone through this total interest rate adjustment period. So not only do you have the business that they are 37% market share of, which is selling reverse mortgages, which baby boomers are going to need, right? Middle-class baby boomers that have no retirement savings are going to need this product. It should have some huge secular tailwinds once word gets out about it, once they do more marketing. So not only are you getting the business and everything they do in the future, but you made 4.8% spread in the past for the $7.5 billion of volume they had done in the past. And because it's just, you don't actually see those numbers until that 5-year mortgage-backed security matures and the company receives the residual. But there's $1 billion here. There's $1 billion on the ground, and you can pick it up for $47 million. Now it's $109 million. So it's absolutely incredible.
I remember you and I spoke about this privately. I think it was in July. It must have been in July this year, because this thing had, I think, a 4 handle on it. And I couldn't understand. Like, I know markets are not that efficient like people believe, but this thing was like had $1 billion guaranteed if you could wait till April 25, and you could buy the thing for 40 odd million. The questions that I had for you then are the same questions that I have for you now. If my Uncle Rick was here, he would, with his credit license hat on, say, you've got risks of duration and then interest rates. I think we've covered the interest rate risk. What happens to these old ladies if they just don't, God bless them, pass away at the right time for this company? So what if they live a lot longer than expected? Are you banking on the fact that their home equity will continue to rise and then they can continue to re-roll these 5-year terms? How do you see that playing out?
So the 5-year re-rolling, that only works on the mortgage-backed security side. So to the customer, they're just getting their $1,500 a month, and then this home equity line of credit keeps accumulating against the house. But even at high interest rates, the floating rate was only 7.9%. And on average, U.S. house prices have been going up 5% a year. So that's quite a chase. And because it starts out so small and compound interest, I mean, mortgages, when you take one out, because you have this huge loan in the beginning, you're paying off almost none of it every month. Yeah. But on the other side, when you start accumulating a $1,500 debt against the $500,000 house, it starts accumulating interest very slowly. So unless there was and I don't know if they cover some of this risk. Once upon a time, this sort of thing was done within life insurance companies, and they would make some estimate as to how long the people live. I don't know if they have any sort of derivative hedging. I mean, I've gone through their statements. It's pretty impenetrable. There's always a few houses who are in, just like any mortgage company, there's a few houses in bankruptcy proceedings. There's going to be a few houses that don't sell for what they're underwritten for. But it would take an awful lot of those to happen for that to overweigh the $1 billion they're about to make. So, I mean, they are mortgage professionals. They are balancing that risk. If you go through all their materials, and that's why they use mortgage REIT accounting formats, which is totally insane. is they really pride themselves on their mortgage expertise and how well they're managing the mortgage business. So that is one of the risks in mortgages that if we had a huge housing crash and property values fell dramatically, that would be a risk. And if we had some huge longevity spike, right? If they make some drug and people start living to be 120, I don't know what their rules are. What happens if you run out of home equity? They just foreclose on you at the age of 105. So I'm not sure what those rules are. It would be worth a call to investor relations. I was in a stretch where I kept on trying to call investor relations to get answers, and I was just shocked at the number of companies that never called me back. So maybe I'm not impressive enough with my own website. But that's those are risks out there. But I think that's pretty small compared to the $1 billion they've already made.
Yeah, indeed. So the first of this is going to roll in, we're thinking April 2025. Is this an old school cigar butt type of trade for you, or are you interested? Do you think this has a longer term compounding component to the business?
Well, I'm gonna have to see what management does with the money when they get it, because you do have. I like to find companies that are run by capitalists or sometimes founders that have a strong interest. This does have professional management. They seem to be decent at what they do. But for it to turn into a really long-term hold, I'll be watching what happens to this market if it really becomes popular in social circles and people really start signing up for this. It starts getting that secular tailwind and they start doing huge volumes. So right now I bought it mostly for the $1 billion they already made that nobody knew about. But also this has a huge secular tailwind. They have 37% market share doing a niche service that a lot of people are going to need. So I'm going to have to, re-underwrite it as more information comes in. Right now, there's also a regulatory change. So there's in the U.S. we have the federal home insured mortgages versus the non-conforming mortgages. So there's a push now from some of the Democratic congressmen and senators to get Fannie Mae and Freddie Mac to start underwriting reverse mortgages and HELOCs, things like that, to help people access their home equity. Because obviously we need more moral hazard in the mortgage system because we didn't learn that in 2007.
It worked out well for you guys in it.
Yeah. So I'm going to be playing it by ear and watching it unfold as the years go by. But just for now, it's still, $1 billion that you can pick up for 109 million, which is just absolutely ridiculous.
Yeah, very, very interesting. I can't help but smile. Management doesn't give guidance on this sort of thing, which is fair enough. Analysts are estimating their revenues at 2025 at 375 million. So it just speaks to how, this is an inside joke. This thing, it's a hidden secret.
Yeah.
And I don't know how exactly you found this particular rock, but I'm very glad that you turned it over, and I'm very glad that you shared it with your subscribers for the princely sum of $5 or $10 a month. So once again, ladies and gentlemen, for goodness sake, subscribe to the Man Substack. Any other comments on Finance of America before we move on to something that's a little more controversial?
Oh, let's see. No, I had another paywalled company I was going to talk about. I don't know if I talked to you about this one before, but it fell 20% today. And it's up since I wrote about it, but it fell 20% today.
Tell me offline and I can buy it up before it comes back again.
It's called the Container Store. Have you heard of this one before? The symbol is TCS, the Container Store.
No, I haven't. TCS, the Container Store.
So they have it's this retail store that sells storage solutions. So little, it's very upper middle class. They're very expensive little closet organizers, cabinet organizers, things like that, which tends to be a good bet because Americans have a lot of stuff. So some people have the thesis, I want to own some of these storage locker companies. The storage locker REITs are very, very popular, trading at very high multiples. This is a different angle on that, which is to sell these upper middle class households all these closet organizing and cabinet organizing. It's like Tupperware, but very high end Tupperware. But at the same time, we're entering into sort of a consumer Armageddon, right? We had this sudden collapse in consumer spending. But there's two reasons why I liked the Container Store, and I made it one of my paywalled stocks. And one is the thesis going forward of the K-shaped economy, that the high end is going to do really well, and then the middle class is going to suffer, and then people are going to trade down to the low end. And I have a really hard time getting my head around luxury brands and luxury companies. So if you ask me, is
I don't know.
Gucci
That
better
that
than
robe you're wearing says differently, but anyway.
yeah. This was a Christmas gift from my wife. She actually we call her the fashion police. So anything that I have that looks nice comes from my wife. But yeah, I couldn't tell you what's better, if it's Louis Vuitton or Birkin. I have no clue about any of this stuff. And so for me, investing in any of it is very difficult. But the Container Store, what they have kind of going on under the hood is that 40% of their revenue comes from installing custom closets. So it's not actually the merchandise they sell out of the store. It's getting people into the store and then selling them these custom closet solutions, which are amazingly expensive. But if your wife has a $10,000 Birkin bag, she's going to want her walk-in closet installed a little shrine for that $10,000 Birkin bag with like a little spotlight and its custom shelf. And so this is a play on this luxury apparel market where people want to have their own walk-in closets with custom shrines for their, treasured luxury apparel items.
Indeed.
And the CEO is tilting into this strategy. So currently 40% of their revenue is from custom closets. They want to get that up to 60% of their revenue from custom closets. So they're really embracing this and pivoting toward it hard. And even going into this last quarter, which is kind of a implosion in consumer spending. So their sales of goods out of the retail store was down 20% year over year, but their custom closet installations were up 2% year over year, even going into a world. And this is something the sales are going to correlate with existing home sales, because when people change houses, they have to go get their new custom closet installed again. So with existing home sales at rock bottom and a consumer Armageddon, they have positive growth in this sector year over year, which is kind of amazing. And if you dig into their financials, another thing I really liked about it is last quarter was actually really bad. But going back for the 2 years before that, if you adjust it for their growth CapEx, they were actually operating cash flow positive and plowing their operating cash flow into growth CapEx. So they were operating cash flow positive and opening new stores, which the last 2 years have been really tough if you're going to be connected to the existing home sales market, because existing home sales have been devastated. So for a company to be operating cash flow positive and opening new stores, totally self-financed for the last 2 years is frankly a miracle. So I'm really pleased with their management and market position. And one of the big risks overhanging them, so they had their share price under $1. They got threatened with delisting, so they did the reverse stock split to get it back over $1. But during that process, management was saying, well, we're going to shop around and see if we can find a strategic partner. In other words, hey, we want to go private, which for all of the companies I'm looking for is the biggest risk, because you've got private equity has more dry powder than the entire market cap of the Russell 2000. Private equity could just literally take private the entire Russell 2000 and they'd have dry powder left over. So any company that shows any promise, immediately a private equity firm comes out of the woodwork and tries to take them private. So the Container Store, I guess, shopped it around and didn't find an offer they liked to go private. So that they did the reverse stock split kind of takes that risk. It's not totally off the table, but it mitigates it a little bit. So that's kind of nice.
Interesting. I don't know anything about closets, but I do know a lot about crazy women who overspend. So I think it's got a it's got a niche. It's got a niche. Medical Properties Trust. Everyone, I started selling puts on this thing, and everyone was giving me some flack, and I said, no. The thesis is solid. There's hair on it. There's some controversy. Medical Properties Trust, where are we at? It seems to be all playing out fairly well. You said last we spoke, the difference was the haters, the naysayers, the short sellers can't directly impact the operations of this business. So they can say what they want. They can't necessarily affect the income statement. How do you see Medical Property Trust right now?
So Medical Properties Trust has been in the dumpster because their largest tenant went bankrupt. Their largest tenant was called Steward Health, and the guy who was running it, if interest rates stayed at zero, he'd be on the cover of Forbes magazine. But with interest rates rising, he blew up, right? He was a zero interest rate phenomenon, and he blew up. And then I think the short sellers latched on pretty hard, and the short sellers latch on pretty hard whenever they can find some way to attach the word fraud 10,000 times a day on Twitter. And the main tenant, Steward Healthcare, they were trying to expand internationally. They were trying to take over hospitals, and in the hospitals they were trying to take over in Malta, there was some bribery accusation from the government. So
that would never occur in that little island of moral virtue.
Yeah, you mean the what is it, the tax haven? The whole purpose of that country seems to be to get away with things. But anyway, not Medical Properties Trust, it's their largest tenant, allegedly tried to bribe some government officials in Malta in order to acquire their hospitals. But whenever, this is similar to what happened to B. Riley, where what the CEOs of one of the companies they financed was a portfolio manager for a hedge fund that defrauded its clients. You have like 3 steps of removal for people, but just that there is any fraud at all in any connection in any way, it lets the shorts just write fraud 10,000 times a day on Twitter. But Medical Properties Trust is the landlord of acute care hospitals. And my thesis when I wrote about it was one of my former students from university, his grandfather has a little commercial real estate empire they've built over 3 generations. And I was kind of getting the in and outs of commercial real estate, helping him with some spreadsheets. And it really shocked me just how devastating it is when you lose a tenant, right? When you lose a tenant, for one thing, these triple net leases are very thin margins, right? And the client, the tenant pays, this triple net, the tenant is paying maintenance, they're paying property taxes, they're paying insurance, and then you're receiving, 5, 6, 7% cap rates on top of that. Now, when the tenant leaves, not only are you not getting rent, but now you're paying property taxes, insurance, and maintenance. And the property taxes on these commercial properties are enormous. A lot of municipalities will limit the property taxes they charge on homeowners because there's a lot of voters, and they try and stick it to business without realizing that everybody pays that anyway, right? You're either going to pay it in the cost of the goods you buy, or you're going to pay it in property taxes. But property taxes on commercial properties are pretty onerous. Well, the thing about acute care hospitals is the municipality and the bankruptcy judges have this strong desire to make sure that there's no disruption in operations. Because if your tenant leaves in commercial real estate, now you got to go to Colliers and say, hey, Colliers, can you find me a new tenant? And they say, sure, we'll find you a tenant. It's going to take us 9 months. And our commission for finding you a tenant is going to be like 4 months rent. And it's now customary in that marketplace to give the new tenant 4 months free rent. So you're out like a year and a half. So you're paying maintenance and insurance and taxes for the 9 months there's no tenant. And when the new tenant comes in, you give them 4 months free rent, and you have got to pay 4 months rent to Colliers for commission. So if in commercial real estate, if you lose a tenant, it's devastating. But if you're an acute care hospital and the bankruptcy judge says, well, clearly the city cannot go without a hospital. Otherwise, people are going to have heart attacks. There's going to be no doctors to take care of them. So there cannot be an interruption of service. Well, the bankruptcy judge is going to find a new operator. And the bankruptcy judge does not charge the landlord Collier's commission. And the new operator doesn't need 4 months free rent because the bankruptcy judge puts them in there. So you don't have 9 months of it not being operated. And also in the bankruptcy proceeding, the past debts are you're a general creditor, but any rent accrued from the first day of bankruptcy proceedings is the new tenant's liability. So you don't even miss any rent.
So this is, I really like this. This does make it exceptional to an otherwise unattractive industry. What's in it for the new tenant? That's got me thinking, like they've got to take on the new liabilities. What's in it for them? State funding?
Yeah, so, I mean, operating a hospital, can be a profitable business. It's been a rough business for a couple of years because the interest rate spike, you only renegotiate with the government Medicare program, Medicare and Medicaid. They only renegotiate prices for procedures once a year. and you only renegotiate prices with insurance companies once a year. So when you have that 9% interest rate spike, your costs have gone up 9% or more, and it's going to be next year when you get to raise your rates for your revenue. So this was a really tough time for hospital operators, but hospital operators, that's their business. They should be able to make money from running that business, right? There's going to be hospital operators that are lining up to run that hospital because that's their business, and they can make profits doing that. So there's going to be bids at that auction. There was kind of a hiccup in Massachusetts. So and I always called it the People's Republic of Massachusetts because they're or Taxachusetts. But Massachusetts and Elizabeth Warren in particular has had this crusade against private equity and private ownership of hospitals. The regulator in Massachusetts made it so the license to operate would only be given to a Massachusetts domiciled nonprofit. So in the bankruptcy auction to find a new operator, any national player was completely shut out of the whole system. So in Massachusetts, of the 5 hospitals that were up for auction from the bankruptcy of this large tenant, out of the 5 hospitals, 3 of them ended up closing. And that was part of my thesis, is like, okay, the priority is to make sure hospitals don't close, but the regulators, these goddamn socialists in Massachusetts, are so just evil. They want people to die rather than give up power, that they excluded national hospital operators from the bankruptcy auction, and the local domestic Massachusetts nonprofits can only afford to take over 2 hospitals. And so 3 hospitals shut down in Massachusetts. So there were some bad things that happened out of the bankruptcy process. But when it was at $4 a share, Medical Properties Trust was selling at 40% of tangible book. I think now it's up closer to 60% of tangible book. But again, the reason why the stock price was up to about $6 recently is because the bankruptcy process of their largest tenant is pretty much over. I mean, we're probably not going to know what a lot of the financials look like until the next earnings call, but I believe that the judge in charge of that bankruptcy project for Steward Healthcare has pretty much signed off on everything and closed everything out. And a lot of the naysayers' worst case scenarios didn't happen. Most of the hospitals found a buyer to take over the lease. And that whole process seems to be done. But we're not going to know what Medical Properties Trust really looks like probably till their next earnings call. But again, this was their largest tenant, but this company still has 400 acute care hospitals, and the whole package was selling for 40 cents on the dollar in a world where they're the landlord with these triple net leases. The liabilities of the hospital operator were never the liabilities of the landlord. I mean, the short case never made any sense to me. And at one point, this thing was trading with a 3 handle. It was $3 something a share. At one point, it was trading for 25% of tangible book. I could not believe it. I catch falling knives. I buy on the way down, but I never thought for the life of me I could see a acute care hospital landlord sell for 25% of tangible book. It was just shocking that the price got that low.
Yeah, I'm having a strange thought here as I'm looking over Medical Properties Trust. It reminds me in a weird way an analogy with the Geo Group. I don't know if you're familiar with the Geo Group.
Nope.
It's kind of a similar situation, except the underlying operations are not the problem of Medical Properties Trust. Now, is it fair to say, whilst it is trading at a massive discount to its tangible value, and I don't think it's going to be particularly easy to replace a company like Medical Property Trust, so there might be a competitive moat there. A lot of people look at the distribution and the dividend yield on this thing. It's currently suggesting perhaps a double-digit dividend yield. Is that sustainable? What might be some risks to the income side of this thesis?
So this is they had some so Medical Properties Trust. One of the bear cases was with rising interest rates, they need to delever somewhat, and they did. So they did about $2 billion of hospital sales to raise money to deleverage. Because when you're at a 0 interest rate environment, they were running about 60% leverage. They probably had to get down to about 40% leverage. But all of the hospitals they sold, except for maybe there might have been one of them, but they were all at their purchase price or better. So none of the hospital sales to lower the leverage amount resulted in a loss. So it was a pretty glorious $2 billion deleveraging. Let's see, but as a part of their debt, they had debt covenants that said no more than 10% of their tenants can be going through bankruptcy. But their largest tenant was 25% of their revenues. So when Steward announced bankruptcy, they were in violation of their debt covenants. Now they went to their lenders and said, hey, we have one tenant went bankrupt, but it was our biggest one and we're in violation of our debt covenants. But hey, we're a fantastic business. And their lenders all said, yeah, you're a fantastic business. Here's 6 months, get out of jail free for your debt covenants. But the steward bankruptcy process took longer than that. So when they went back to their lenders the second round and said, hey, those covenants, we still need more time. They said, okay, you can have more time. This time we'll give you a year and a half. But for the next year and a half, you can only pay 8 cents a quarter in dividends. So their funds from operation, which are what they pay dividends out of, is something like 24 cents a quarter, give or take. And as a REIT, they have to pay out 90% of that.
Okay, so they have
they have to pay out 90% of net income.
Sure.
But when this company gets back into its steady state, when it gets back into normal times, the dividend is probably going to be something in the range of 20, 22, 24 cents a quarter, give or take, which would be, call it 80 cents a year on $5.76 at the current share price. And that is a huge dividend. But that's not what it's doing right now. Right now it's doing 8 cents a quarter because of the debt covenant. Sure. Now, with the steward process behind them, they can go back to the lenders at any time and say, okay, this contract we signed to remove the debt covenants, we can go ahead and undo that now. We can go back and pay a dividend. They can do that anytime between now and I think September 2025. So because of the write-offs and all this accounting stuff, whenever a company has a write-off, I mean, I think that should just be a purely balance sheet thing, but it shows up in income. So they have a net loss this fiscal year because of the equity write-offs surrounding the steward bankruptcy. So they could pay 90% of income, which is negative. So they could pay no dividend and keep REIT status. But when you get into 2025, it's a different story. They have to pay 90% of net income or lose REIT. They're not going to lose REIT status. They have to pay 90% of net income. The question is, what is their final steady state funds from operation going to look like? Is it going to be 20 cents? Is it going to be 26 cents? We don't really know. We'll probably have a better idea after the next couple of earnings calls. When are they going to go back to the lenders, which gave them this leeway for the debt covenants, and say, okay, we're ending this contract now so that we can go back and pay more than 8 cents a quarter and get back to 20, 22, 24 cents a quarter, something like that. I mean, that could happen June of 2025. It could happen December this year. Medical Properties Trust has the flexibility right now. Like, for example, because they have the negative net income from the write-offs, if they wanted to take their funds from operation and pay down a little debt with it this year, they could. If they wanted to do a share buyback this year, they could.
Oh, they can do that as a REIT?
Yeah. So a REIT has to pay 90% of net income, but they have negative net income this year. So sure, they're still getting paid rent by their tenants, but because of the write-off, the equity loss, because they did own, I think, 9% equity in Stewart. So that was a $750 million hit to book value, which is not pleasant, but it was trading at 25% of tangible book or 40% of tangible book. I mean, it was, let me see what the asset value. So they took a $750 million hit to book value, but their assets are 18.3 billion. Let me put it quarterly, get the most current one. So it's not nice, but it's also not devastating. But this year, they could choose to do something else with their cash other than pay dividends. If they wanted to do a little share buyback, if they wanted to pay down some debt, if anything, they might pay down some debt, or they might keep the cash and earn 4.5% on it, because their long-term debt outstanding, I think, only has an average yield of 4.3%. So there's no harm in keeping some 4.5% yielding cash on the balance sheet for a while, just to have a cushion. So yeah,
my question was more
they have some flexibility.
Structuring. I didn't know as a REIT you were allowed to buy back stock. I thought you had to do a corporate change of status, like Geo Group did, and like Texas Pacific Land Corp, which was a trust, is now a corporation. That would be very interesting if they can start to buy back their own stock when it's at such a discount to.
You could be right.
I don't know. I'm just thinking into the future of certain tailwinds that this company might have if they could put it to a vote. I don't know if they'd be allowed to do that given the nature of how they operate or who operates on their premises. But I mean, if this thing could start to buy back its own shares, given how cheaply they're trading against the asset value, holy moly.
Yeah, I mean, you could be right. I know that they have to pay 90% of net income in dividends, which means that covenant that limits their dividend could be a problem for them. And what they've been talking about recently is, well, they might have to return capital to shareholders in a different way to get that 90% payout ratio. I think they were hinting at maybe doing some stock-based dividends, which again, it doesn't really do much. But I don't know all the nitty-gritty of those REIT rules and what they can do. But I knew they have some flexibility right now while they have negative net income, but they also have this contract covering their covenant violation. So
and
there are
presumably
some unknowns for what they'll do.
That covenant's not going to be there forever. I mean, once they get new tenants in, I mean, all the prerequisites have been met, right? So they can.
Yeah. And they already have new tenants. They have 15 hospitals with a temporary tenant. So they're going to be immediately preoccupied with finding new long-term tenants for those 15 hospitals. But I think right now the official ruling from the court is they're completely severed from the entity that is Steward. There is no more relationship now between Medical Properties Trust and Steward. That is completely done. And that got the stock price up from $4 to $5.75.
Interesting. Very interesting. Any final comments? The floor is yours, sir.
No, just I think New Fortress Energy was down about 10 or 11% today. That was a brutal sell-off.
I haven't even had the chance to look. But that's,
and
I mean, if it's not a double-digit down day on New Fortress, is it even a down day? I mean,
yeah, I'm just amazed because I think they're guiding toward next quarter having EBITDA up to 275 million. And some of my subscribers keep sending me this stuff they're reading on Seeking Alpha about the bear case for New Fortress Energy. And I'm wondering if there is a certain amount of momentum, and that when a price falls, it's likely to keep falling. So I wonder if New Fortress Energy has attracted some shorts because of the large price crash. But the short reports I've seen on Seeking Alpha, like for example, one of the people was saying that, well, the price of diesel is down, so that'll hurt them in their Puerto Rico contract. But the problem with that is they have derivative hedges. I mean, their spread, $7 per MMBTU of natural gas, that spread is fixed in with hedging contracts. They have completely locked in their profit margin. And so you can just take their 1.8 tera BTUs and add $7 per MMBTU, and you know exactly what they're going to make because they've completely locked that in. Their natural gas purchasing contracts are for more than 10 years. They've got diesel derivative hedging. So the short reports that I've seen on Seeking Alpha, I don't want to be mean to people, but they either weren't very well researched or they were just trying to get the stock price down because they just weren't very good.
It's got
but I
short
still like New
interest at the
Fortress.
moment, so it's got a lot of shorts piling on the bandwagon, which could reverse. I still, I see the case for it. I don't know exactly what has happened other than people were talking about there was fear around the contracts being cancelled. But as far as I'm aware, that hasn't happened and is unlikely to happen.
Yeah, and again, they were playing fast and loose with language, and maybe English wasn't their first language, but they were talking about where within the FEMA contract, the Puerto Rican Power Authority had the right to buy the power plants. So it wasn't that the contracts were canceled. I mean, the contracts are good, the contracts were completed. Yeah. And then New Fortress Energy got a new contract to fund those power plants for the next 4 years. So they were, this is again the same Seeking Alpha article, but I think they were playing with language a little bit to make it seem like things were bad. The name for that is named after Bertrand Russell, the British philosopher. They call it a Russell conjugate. So, and this is a really good way to find out what the bias is of anybody in media. So, for example, if I say undocumented worker or I say illegal immigrant, well, it's the same person, right? They're the same human being, whether they're an illegal immigrant or an undocumented worker. I can choose the language to try and control how you feel about it. That's called a Russell conjugate after Bertrand Russell. And when people use Russell conjugates to try and construct an outcome they desire, you can tell what their bias is. And these Seeking Alpha articles about how bad New Fortress Energy is, they're not trying to give you a reasoned analysis of New Fortress. They're trying to create an outcome. So I'm pretty pretty dismissive of those short. They don't present themselves as a short report. They present themselves as some sort of ambivalent market research, but you can tell by their Russell conjugates that they want the stock price lower.
Interesting. So some final questions. Some analysts now have flipped in terms of their projections of cash from operations. They're apparently going to run a loss this year and next year to the tune of 845 million and $1 billion loss cash from operations wise next year. How is that going to happen? How are
that one I don't know. I mean, management's guiding towards $275 million of EBITDA for Q3 and Q4 of this year.
Mm-hmm.
So unless management is way off, and for that to not happen, then their Puerto Rican Power Authority 4-year contract would, and the only way that that could really happen would be the cancellation of their 4-year Puerto Rican Power Authority contract, which I feel like that would be hard to get it's not exactly a government entity. It's a government adjacent entity, the Puerto Rican Power Authority. And they do have troubles maintaining the grid. It's not a well-run entity, but it is Puerto Rico, but it still has some rule of law. I feel like they can't just do take backsies and cancel the contract. And it's also a mutually beneficial contract. They're lowering the cost of electricity by 25% from those facilities. So it's, it seems like an unreasonable case. And another aspect, so the only aspect about the short reports that was actually true was that we really don't have a time frame on when they're going to get money from the reconciliation process of the FEMA contract. We have no clue when that's going to happen. But then they, the really hyperbolic short reports say, oh, well, maybe they won't even get the amount they think they're going to get. Maybe they're not going to get any amount at all. But government contract reconciliation processes they're pretty standard. It's not like a total unknown. I mean, is it going to be $580 million or $650 million? It should be a pretty big chunk of cash with a totally unknown delivery date, not 5 years, but not 6 months.
Okay, interesting. So long term, what kind of cash flows can this thing produce, or what kind of net income, probably best to say, can this thing produce after they've spent their capex?
Yeah, I mean, it's minimum should be $1 billion of EBITDA. I think their interest payments were something like 200 million. So call it, 750, 800 million plus of net income. And what is their market cap now? 1.9 billion. So would be less than a forward PE ratio of 3. I'll be buying that all day long.
Okay, there we are. Debt wall has been, the maturities are no issue as far as I can see.
So there is some scary language surrounding their debt. They've got several debts that if they reach a certain time period without refinancing their debt, 2 other debts are also immediately maturing. So there is some very scary language in their 10K reports about their debt wall. But if you read the very next paragraph, the one debt maturity, they have an already pre-approved refinancing agreement. So there's one, I think it's an $850 million loan that matures in, I think, some month in 2025. But it's already pre-agreed with the lender that they can just swap that out for an $850 million loan for, I think it's 2028. So they already have a pre-refinanced agreement for this debt wall. But if you do read all the footnotes in the 10K, there is a very concerning and scary sounding situation that if one debt isn't refinanced, 2 other longer term debts immediately are maturing at the same moment. But the debt that triggers that has a pre-agreed refinancing agreement already there. So they can just sign a piece of paper and get 3 more years on it. It's not really a big concern at all.
Very good, sir. Any final comments before we wrap up another value-packed episode?
Well, I had talked about forward air, and that just keeps on grinding higher. But there's still the threat that the private equity firms that now have, I think it's 22% of the stockholders agreeing with them to take it private so that they can write it up to $100 a share without the rest of retail participating. But in the meantime, as they accumulate shares, it slowly is grinding higher. And then I had spoken before about Newell Brands.
Yeah.
And even though their last quarter, they were net income positive and paid a dividend, the stock price just will not move. So that's kind of interesting. And it's, who knows at what point it starts taking off and rallying, but their turnaround strategy, the fundamentals keep getting better and better, and the stock price stays the same. So at some point, the stock price has to keep up with the fundamentals.
Indeed, we'll be keeping a close eye out. Thank you very much for watching, ladies and gentlemen. Link in the description to the Substack that is the Unemployed Value Degen. There is a ton of value in that Substack. It will keep you entertained for many, many hours. Thanks for watching, guys. We'll catch up with you in another episode shortly. Take care.